So we're going to be talking about tokenization here, which is pretty broad. I love broad topics. Then I can just kind of riff with whatever the audience wants to talk about or whatever I want to talk about. We're at a very interesting time in the crypto marketplace. I think we can all agree. This time last year, going into Consensus of Invest, many may recall, that was the day that Bitcoin first hit 10,000. And that was actually ahead of my prediction. I had predicted in early 2014 when it was about, I think it hit 1,000 and then went back down again, that it was going to be 10,000 by the year 2020. And I got laughed at by a lot of people, but it was a couple years ahead. Usually when things get ahead of themselves, as we noticed in 2013, they tend to then go down. And now, as Eric Voorhees just tweeted this morning, we are now in the euphoria phase for bears. Which is an interesting way of looking at it versus the opposite. So stablecoins, which we're here all to talk about, are very valuable for active traders. I know there's a lot of other cases because it means that you can go in and be going back and forth in and out of various tokens and not have to worry about going into US dollars, waiting for the couple of days for it to go in and say, nope, I want to buy it back again. So, obviously that is valuable. It's interesting, of course, that stable coins haven't been completely stable. They've oftentimes gone higher than the spreads that you get on just, like for example, one of my main exchanges I use is ItBit. I don't know if there's anybody from ItBit in the audience. I think I saw somebody who was speaking there from it. And they're, I think, at about a quarter of a point or something. Well, there are many days when some of the stable coins are, almost a point above or a point below, depending on supply and demand. So it seems that, we'll talk a little bit about the stability of stable coins. But, right now, I mean, I've said for a while that there's really, other than the stable coins, there's utility tokens, there's security tokens, and there's chicken shit tokens. And the chicken shit tokens are the people who really want to be a utility token, but their lawyer told them they can't be, so they better be a security token. And I think right now we're still nowhere near clarity from the SEC. It'll be interesting to see whether Jay Clayton, who's speaking tomorrow at Consensus of this year, where we're down to 35% of where we hit a year ago after doubling within 6 weeks after that. If he gives any further clarity or, as expected, just continues to double down on the FUD. I think it's unconscionable. I've said this a few times, even though it has been the SEC's history in other asset classes, to basically not want to make any regulations while they're unclear that they might lose in a court case, so they simply go and double down on enforcement actions of the low-hanging fruit.
Disagree.
Okay, go for it.
So, is this on? So I teach law at Fordham Law School. I ran an exchange, the commodity exchange, and traded both gold.
And say who you are, just so I'm Michael Turpin.
Yeah, we can do round two.
So that when people refer to the stable coins that are backed by gold or silver, I ran that exchange, so I know a little bit about those subject matters. I do not think that the SEC has been in any way irresponsible. If you look at just the trajectory of what's been going on in the industry has changed so rapidly that making any kind of laws in the way in which you go about making laws, where you propose them, you have responses, you have comments, and everything else, those laws already would have been outdated with where we are in terms of everybody moving from the ICOs, which mostly were unconscionable, to the security tokens, to stable coins. So an agency does their job slowly as the market evolves, and it doesn't run ahead of it at all. So
So having worked with 110 ICOs, I would dispute that most were unconscionable. And I would also say that we're 5 years in, and we haven't even had a proposed regulation. Any thoughts on that? Anybody else?
Yeah, I'd like to interject here. So Alex Panasuk, founder of the StablecoinFoundation, and I couldn't agree more with you, Donna, with regards to, 77% of ICOs supposedly were a fraud last year.
Let me just correct that fake news, please. So that was put out as an initial report by a group that had never put a report out.
Okay,
it
fair
was
enough.
somebody who had spun off, actually, I understand, got fired from somebody who was putting on ICOs, and they put out something, and their criteria to see whether something was a scam was, were they still on Twitter?
Well, fair enough, but I think most people would agree that probably a lot of the ICOs last year were frauds, and people
Nowhere
were
near that percentage in terms of money raised.
Fair
I would
enough.
say EOS is not a fraud.
Yeah, yeah. Well, how many people here think the majority of ICOs last year were frauds? You know, maybe half the room. But Michael, let me.
EOS is a fraud. Go on.
All right, but let me go on for a bit here. So, you know, I think one of the purposes of the Stablecoin Foundation is to develop a global network of trusted professionals that can help understand what's really happening and build relationships with regulators, legal experts, and policymakers so that we can actually move the industry forward. I think one of the things that I've seen over the last year is that there's a lot of criminal activity, people losing their money, people not understanding what they're doing, getting caught up into hype. And we really need to regulate the markets. We really need to educate consumers, investors, and service providers so that we can actually move this industry into mass adoption. And for institutional money to come in, for people to really invest, we really need to, you know, regulate. We need to provide custodial services. We need to come up with some sort of securities. And stable coins are the evolution of digital money. You know, when I came into the industry, I got crazed with trading Bitcoin and thinking that was cryptocurrency. But over time, my understanding evolved, and I don't think of Bitcoin as a cryptocurrency anymore. I think of it as a speculative investment, and I think of stable coins as a way towards using a digital form of money. But which one should we invest in? Which one should we use? I mean, that's the problem right now. The whole market is exploding while, you know, we're going through crypto winter. We're seeing stablecoins doubling this year. I think next year, based on the trajectory, we could quadruple the number of stablecoins next year. And so which one should we use? And so we at the Stablecoin Foundation want to help educate, we want to research, and we want to figure out how we can work with regulators.
So I just have a quick question, and I'm going to go to the rest of the panel. You used the word invest for stablecoins. I think of stablecoins as basically being like a passbook savings with no interest. So why would an investor, other than simply to have a place to put their money back in between other investments, invest in stablecoins?
I actually agree with you on something. I think that there's a difference between, which is the angel side of my life, investing in the company that issues the stable coin, which is the management, the team, the analysis that you do, whether it's an angel investment that is going to build you know, a new product that's a consumer product, or it's going to be doing a new technology. So that is one part of it. But when you say invest in the stable coin, you've already put yourself in the SEC domain. So if you're investing in it, that's one of the prongs of the Howey test. So I would be careful about terminology in everything that we do in this industry because we use words very loosely.
That's one of four. I'm sorry, it's one of four because obviously I invest in antiques, I invest in classic cars, I invest in fine wine, and I invest in rental properties, and none of those are SEC regulated. Please, Eden.
For a very good reason why.
So you know, I agree with both of you, actually. Yeah? I agree with Michael that not everything that's an investment is a security. I invest in my relationship with my girlfriend. Not enough, apparently, but I do. And I also agree with Donna that we don't need new regulation at this time. In fact, I don't think we'll ever need new regulation. The regulations that exist for securities have been in place since the 1930s, and they've done a good job under many, many different and changing circumstances. There is a substantial risk of regulatory overreach. Just the term, a security token, is nonsense. The tokens do not exist. They are proofs of a registration or a mathematical activity that has been performed on a blockchain by nobody in particular. So if I have a token that was sold to me by Donna, with the goal of making a profit, that might have been a security issuance, but the token itself, now I can deposit it into, let's say, MakerDAO, which is a smart contract. Immediately, that token no longer has any legal person that owns it, and therefore cannot be a security. It's not an agreement of any kind, and therefore is not governed by any law except for the mathematical laws which govern the blockchain. And that's the really difficult thing for people and regulators in particular to come to grips with.
So you have a nice Medium post on that you wrote in this last week. I would disagree with you in that the SEC did say one of the few times they were clear on something, and this was actually because that kind of argument was going around because of the DAO, was that there's no such thing as a DAO, that if you're able to fog a mirror and you are part of a DAO, even if there's no ownership of the DAO, and you're actively involved in selling what they later considered to be security, and let's be clear, I think the DAO is absolutely security because it said, hey, put your Ether in here, we're going to vote on what you're investing in, you're going to get returns and dividends. That's clearly a security. That meets all four legs. And the defense was, oh, well, it's a DAO, it's not really controlled by anybody. They basically said in their initial, throw over the bow in July of 2017 that started all this, that we're going to consider this a learning moment and not go after the DAO, but it was a security, which I agree, and that if you fog a mirror, you're part of you're subject to the SEC if you do it in the U.S.
Security. The token, the DAO itself cannot be a security, right? Any more than
No, I meant the DAO. I meant
Right.
quote unquote the DAO, the actual.
The sale of tokens from the DAO could definitely be a security issuance, of course, right? And I agree with you that it was, but once those tokens, I'm having bad luck today. Once those tokens begin to circulate among across smart contracts and no longer have any entity which owns them, I don't see how, without a substantial reinterpretation of all known law, you can have something which isn't owned by any person which represents a security.
So I think this is part of the growing up of the blockchain industry, is the cypherpunks have conceived of a world outside of traditional law where math has no law. It's the law of math, and the traditional laws have no place or understanding. And the fact is, we live in countries, and those countries have laws, and they have views on things, and they're going to find a way to implement those laws. And I think if we accept that the regulators have a good motive, not an evil motive, even the SEC, which I know has a bad name in the blockchain industry, but their motive is to protect investors. And if we embrace that motive, we'll recognize the true value proposition of blockchain. And one of the things we've been trying to do at New Alchemy is really embrace that and identify what is the real value proposition and how does that work in the laws of different jurisdictions. So I worked in Congress, advising Congress on digital currency related issues and derivatives regulation, and I worked at the CFTC when we were standing up all these laws about this and starting derivatives and Bitcoin, that sort of thing. And they're really, and I've talked to senior Treasury officials about it, it's important to the government to do the right thing, and that is their motive. And so as the industry, it's incumbent upon us to keep that in mind and say, how are we going to do the right thing, and how are we going to bring the technological promise of blockchain and marry that with the goals of the law, which may not have envisioned this exact application, but they can find common ground.
And so, of course, when you're saying the government, you're talking the U.S. government, because obviously Malta, Singapore, there's a lot of other people saying, come on down.
Yeah, well, we're mostly.
I was in Malta 2 weeks ago, and they just enacted their laws, right? They just became, active in the 1st of November. I have a question, though. With regards to stablecoins, what are your views on stablecoins being a security or cryptocurrency and being covered under the law?
Well, personally, I think stablecoins are a critical element of de-risking. And you're really seeing the challenges of investment right now with this incredible kind of volatility in the market. I remember in the market crash in 2008 telling my broker I wanted to get out of the investment I was in. I wanted to get into cash. And because I wanted to de-risk. And even businesses have this challenge. Blockchain, if you want to have a successful business in blockchain, how are you going to realize that success without constantly gambling on the overall crypto market? You've got to be able to de-risk to have a successful business and to be a successful investor. De-risking is a critical element.
That's not the answer. That de-risking is what you do, but which agency is responsible for it. And I would say, going back to, since you have the Stablecoin Foundation, I think whether it's the Stablecoin Foundation or the people that work on security tokens, it's incumbent upon people within the industry to work together, or real estate tokens, to define the parameters in which that protocol, that digital asset is based on. It's confusing also if everything is called something different. So is it a security token? It's an STO. It's what is it is very important for people, not only the regulators, but if you want adoption by institutions or retail people, have a nomenclature that's consistent with a product that is relatively fungible. Not that each thing is, but they understand what it is, whether it ultimately ends up in baskets or in ETFs or any of those types of new products. It's got to be comprehensible. So if that's part of the function of the Stablecoin Foundation, or if the Digital Asset Group does it, that's very, very helpful. And Michael, you do marketing. That's an incredibly helpful thing for all of the different stakeholders to know, what are we really talking about now when we say stable coins? We know there are different companies that issue them, but what's the characteristic that everybody would know these 5 things?
Well, yeah, I couldn't, I have to completely agree that, the Stablecoin Foundation is trying to work with professionals globally in their trade to come up with a taxonomy that we can all agree on. What is the definition of a stablecoin? Because even the issuers, right, we were in touch with 120 issuers, and 37 of them have different views on what a stablecoin is, right? And those are from the issuers, let alone the market. And so we want to be able to come up with a common glossary, common terms, and really define what a stablecoin is. What are some of the guidelines, codes of conducts, policies, guidelines, best practices? The list is endless. So, think about what a professional association does. Those are the things that we want to do that were done already in FX, for example.
Well, marketing does define terms once industries come to grips with them. Unfortunately, they start with the tech guys, right? If you go back to the early PC market, they called them 8088 processor technologies instead of personal computers, which finally became a little bit more easy to digest. And I think, here, utility tokens was sort of a term that was meant to kind of say, that it fit into some regulatory bucket. I've often said that, if ICOs were simply called token starters because they really look more like Kickstarters, it probably would have been a further, distance to getting the SEC hot and bothered in their turf war with the CTFC. Because I personally think that, ones that logically, it's the 4th leg of the Howey test, by the way. We're talking about the Howey test. It's 1946 Supreme Court case that sort of modified the 33 and 34 Acts. And I do think that you do need to sometimes at least consider updating laws. It's not the Bible or the Constitution. Even the Constitution has amendments. Because, the Howey test was just at the dawn of television. It was before the internet, much less before cryptocurrency and the blockchain. So that the first 3, I think in most cases are pretty easy to understand. Is there an investment of money, which for the most part means that if none of the other ones show you your security, you can't airdrop. You can't airdrop securities, but you can airdrop consumable tokens. Second one is there active efforts of management? It's a common investment as opposed to like it's just you partnering with someone? Others, yes, others. And so in other words, wine is a good example. Wine futures. Gee, it sounds like a security. It's a futures contract, but really it isn't. It's just a nickname, right? So you have an active investment of money into a product that hasn't even been built yet. You're giving Screaming Eagle, $1,500 a bottle or 30,000 a case or whatever for something. They're going to go and use your money, buy the grapes, make the product just like a Pebble watch. It's called investment grade wine, so you have an expectation of profits. It's a common enterprise that you have no part of the results. You can't call up and say, I want more Merlot. But the day that the wine ships, if management resigns over an accounting scandal, but Robert Parker likes the wine, it's going to go up in value. That last one is the increase in value because of the asset or the active efforts of management? That's where I think we need clarification from the SEC.
Well, We'll agree to disagree. We'll agree to disagree on the. I don't know. I mean, I just taught 30 law students from different countries because they're LLM students as well, and none of them seem to, at the end of the day, after having studied the Howey test and applied it to all different elements of both blockchain, stablecoins, and everything else, seem to think that they needed to rewrite the Howey test.
Just clarify.
Yeah, maybe we can think about that. But now I lost the point that I wanted to say.
So the conversation here, as very often happens, is revolving around the Howey test and the SEC. But it's important to remember that the Howey test and the SEC are American regulations. And while the United States has this tendency to believe that its laws apply everywhere on the globe, there are other laws in other places. And that's what's so interesting about blockchain and, by extension, about stablecoins. That we have a global world today where a lot of people live their lives in all kinds of places. They communicate with people around the world. They do business with people around the world. And yet, laws are still gated according to these geographical locations. And we have global problems like climate change, which as a result are not being addressed. Now, it just so happens that financial issues are one of those extremely super globalized issues because they deal with the finances and trade and the movement of money, which is a global phenomenon. And we don't have a way of organizing ourselves or regulating ourselves on a global basis except for blockchain. And that's what's so exceptional about blockchain, because the rules, the regulations, and the consensus that govern blockchain transactions are not based on any geographical law or on, the liberal arts version of law, but instead are algorithmic and therefore global. We have a new way of organizing ourselves, which is global as well. And that's why stablecoins can move anywhere in the world, regardless of whether they are dollars or euros or yen. And that has a huge amount of utility. And it's crucial that we as an industry recognize that as one of the key utilities, one of the key USPs of what we're able to bring, and that we explain this to regulators, including the SEC.
Yeah, I would just like to say one thing about, I think, it's really important for people to understand, and just to add on to what you're saying, it's not just about the invention of technology or blockchain or decentralization. It's really an evolutionary step in how we think. Right, it's really Web 3.0, Industry 4.0. We're hearing all of these terms, but people, industries, technologies, law, even money and finance is being redefined right now. And I think we all need to work together to really figure it out. And nobody has the answer right now. People think that the existing framework can fit into this frame or that. And like you said, as we globalize things and as we decentralize and we develop governance structures around that, I think we're really moving towards a global economy, a global currency. Global trade is going to be much more supported, but how do we do that, I think, is a big question.
But if we go back to the definitional elements of when we look at stablecoins, you're going to have to look at how was the money raised in order to be able to see what that offering was. It may be that the industry, in concert with your type of foundation and the government, decides that the token per se is not a security. But you need to make that decision in conjunction with the regulators pretty soon, because otherwise they can't float around the world. Because if they're sold to non-US persons and it's deemed to be a security, you can't get them back into this country. And if they're sold to US persons, and they can't go floating all over the world on other exchanges that are non-security exchanges. And then you need to also decide if they are securities under any kind of a UBRIC, where can they actually trade?
So I think with
with the Ether Delta problem,
right, so I think with
10 days ago.
I think that you're going to have a lot of Ether Deltas around the world that just going to block the U.S. because decentralized exchange is the future in terms of exchanges because of a lot of these things. But in terms of stablecoins, I think you have to separate the company that creates the stablecoin environment and raises money to do that. That typically isn't even going to be a token. It's going to be a venture capital or PPM company. And then the stablecoin itself is usually backed by something. I mean, the original one, Tether, which we were actually involved in the marketing of, when it first was called Real Coin, and then when it was rebranded Tether, that was backed by dollars in a Puerto Rico bank account.
Yeah, and I would like to add that, you know, a lot of stablecoins want to be considered a global digital currency or a cryptocurrency and be considered like Bitcoin, right? And deliver on the promise of what Bitcoin has been, you know, touting over the last 10 years.
I have to say, it's incredibly ambitious to think that a stable coin or even a collection of stable coins is really going to replace or not have to be referencing the fiat in a particular country, because the debts that people incur to run their businesses or to run their personal finances, they exist in a country and they're denominated in that currency. And in the end, they have to offset each other in that currency. So as a practical matter, I think people live in a place, and that place has laws and it has currencies, and until you have an extremely broad adoption, which is not happening next year, people are going to have a way of doing that.
I don't think other than government issued ones that you're talking about stable coins reflecting debts or anything to do with the GDP. It's simply a bucket of things that are backed by a bucket of things. So it's tokens that are backed by $100 million in a bank account or $100 million of gold. That's one-to-one backing.
It's all commodity.
Right.
Right. So
Agreed.
You pick the commodity you want to back it by. Make it silver, make it gold, make it dollars, make it
Math.
whatever, pesos, make it math, make it whatever you want it to make it. But if you want it to be a de-risking instrument, and I don't understand what value it is if it's not a de-risking instrument, then it has to be referencing your other obligations. And
Well,
those
dollars
other
aren't a
obligations-
commodity, right? They're a currency. And
What's that?
Dollars aren't a commodity, they're a currency.
Well,
right?
they're an exempted commodity.
So, because again, if it's gold, gold can drop 10% or go up 10%. If you're based on the dollar and you live in the U.S. and your stable coin like Paxos is $1 and it's always $1, it's $1.
But is that
Back-
stable?
Well, it's stable because it's $1 and it's backed by dollars in the bank account. Same
Well,
with the Circle.
Depending on who you are, stability is relative, right? And so that's one of the things about stablecoins is what's to say that it's stable? And it's stable to relatively something of value in a fluctuating market. And I think that's something that's really interesting right now is that, you know, how do we gain people's trust and confidence so that they'll use it and they'll adopt it? And I think, you know, to your point, I would agree with you in the short term. But I think there's a journey going from you know, fiat-backed stablecoins to commodity-backed to hybrids of baskets of mix of either various currencies or commodities to crypto assets. And ultimately, I think, you know, it would be great to see digital, global, decentralized currency that's just backed by the use and trust of the larger population. But that's a journey, right?
That would be great journey for somebody, you know, or maybe for your foundation to actually detail, because people keep talking in vague terminology about a pathway forward. So think of stable coins in the aggregate as a startup. There happen to be under that startup many different different companies, some of them quite well funded, some more than others. But in aggregate together, they need to have a focus of how do they gain adherence and adoption going forward, including clarification as to what they are considered under any regulatory rubric, we'll say specifically in the United States, because most of us are here and many of the companies are from here.
And I would say one thing that we're trying to do that's very critical is to develop standards. We all want to work together as an industry so that if we develop standards, we can help move the entire industry forward. And if you think about the potential upside for cryptocurrencies versus the traditional markets, it's massive, and everybody can win together as we, you know, revolutionize and take advantage of these technologies. I think there's a lot of questions.
Okay, great. I'll ask one question, then I'll go to the questions. What laws are, obviously I can think of two already that are U.S. You know, backed stable coins, the Pax from Paxos. You know, I know that they have Sheila Baird on their board. They've got, they're a depository trust. They're New York State Department of Financial Services backed for the exchange. And then obviously Circle has got Goldman Sachs backing it. So those particular ones that are backed with U.S. dollars, are those the types of things, and are there any additional ones, regulatory, that stablecoins must comply with if they have dollars backing them? I know they got FDIC, but that's only to 250,000.
To me, the law is pretty clear, right? The law governs circumstances where people enter into obligations one with another. Now, there's many circumstances on the blockchain that doesn't happen, and it's a mindfuck. But it's something that we need to pay attention to. You mentioned earlier that it's extremely ambitious what we're discussing. But I think to think about blockchain in any terms which are not extremely ambitious is to miss the point. So I'll give you an example. MakerDAO creates dollars. They call them DAI, but they create dollars by having people take Ether, which is a non-existent thing, and introduce it into a smart contract, which then lends them dollars in return. They're taking loans and they're margin trading against themselves. This is not something which can exist outside of a blockchain environment. It's not something which could have been envisioned by any law, because it's a loan that somebody takes against themselves where the counterparty is software which is not controlled by any given party. Now, how do you regulate that? And
They're based in San Francisco, too.
Yeah, Maker?
I believe so.
No, Maker are the team is global. And Stephen is in San Francisco, but Stephen just was recently hired by them. So I would put to you that there is no way that you can regulate that type of activity, and indeed there's no need to regulate that type of activity, because there's no agreement, there's no obligation that two legal entities have entered into at all. And that is the beauty of it. It stands outside of the existing regulatory space.
I would actually disagree with that one and be on the side of regulation for that one. Yeah. If you're going in as a U.S. person and borrowing money in the United States, I think there are some laws around that.
From whom? Whom are you borrowing it from? From yourself. The left pocket gives to the right pocket. That is not regular.
Over all of this, you have the very strong anti-money laundering rules that come into effect. So whether you're doing a stable coin on an exchange, or you're using, whether it's centralized or decentralized exchange, or even if you're going in between people, I can't say if you're just borrowing from yourself, but if you're in between people, the anti-money laundering does come into play, and it will come into play across the world, because the world has been focused on.
And that's why we need regulated.
I support that 100%. When you have two legal entities entering into an obligation or agreement between themselves, that is classic activity that people have been involved in, and there exist laws to deal with that. We don't need new laws. We just need to be sophisticated enough to recognize when that is not what is happening.
One other point, which has not so much to do with law, but I heard on an interesting, which I love, the Flippening podcast. And they did a 3-part documentary on security tokens. And one of the interesting things that they said, which was not about security token per se, was when they were talking about real estate, and I don't know the answer to this, was that since real estate itself moves so glacially, could it in and of itself become a stable coin? I don't know the answer, but I thought it was...
By the way, you know, that's one of the hot topics within the stablecoin industry is should assets like real estate or arts or others be considered part of a stablecoin solution? I mean, we don't know right now. Yeah, we have a lot of questions. So Steve, do you want to go first? Oh, sorry.
Okay. So Ethereum is not considered a security. So what would it take for a stablecoin on a DEX to not be considered a security also, like Ethereum, or ruled in the same way?
Well, I mean, the answer is that was a very specific decision by the SEC. It wasn't actually even
opinion.
It was opinion. It was first done by Hinman, and at that time, if you remember, Ether was being used for all of the different fundraisings, and they knew that they wanted to have very detailed wording that was only supposed to be applicable to Ether, and they separated, even in the Hinman statement, the raise of the money from what the token had become, and they did that very clearly because they didn't want the two things to be together for other people to think about what they might be doing on the way in which they raised their money versus the token in which they have.
So in the
Try the CFTC too.
in the scope of one-to-one fiat-backed stablecoins, which I and others think are the most legit of the stablecoins, there's only KYC and AML when you get the coin. and there's only KYC and AML when you get rid of the coin and turn it back into dollars. There has been some rumors that FinCEN may change the rules such that you have to KYC whenever there's a transfer. And so question is, can they actually do that because it's being done by this blockchain thing, which is not a regulated entity? Are they going to say, hey, the blockchain, we're now going to regulate it as if it were a bank? Do you think that will happen? And is that a good thing or a bad thing? And, you know, because I've talked to banks, and banks said, oh, you know, we're afraid because it comes in, it goes around into this mess, and it could be millions of dollars, and it comes out the other end. We're afraid of dealing with it, so we'd like everybody in the chain to be KYC'd. So there's clearly, you know, some demand from the banks to want to have this so that every single transfer goes to someone who goes through KYC and AML. Good thing, bad thing, is it can destroy things? Can the regulators actually do it?
I mean, it can certainly hamper us, right, for adoption, and it can make things much more complicated, but it's a perfect example, I think, of potential over-regulation that can set us back. You know, what's the real purpose? I think we need to ask the question about why are regulations there? I mean, you know,
money laundering.
Yeah, exactly. I mean, it's not just money laundering, but it's also, you know, people want to track money. Are they paying their taxes, right? And so, I think we need to, you know, as part of what we want to do with the foundation, we want to work with regulators to understand, okay, what are they trying to achieve, and how can we leverage technology? How can we work with the issuers to figure out how we can use common sense regulations to do the things that they want to try to achieve?
Well, I think right now, and I've said this a few times, that we're living in an era of crypto-McCarthyism. And instead of looking for a communist at every cocktail party, we're now looking for a KYC, AML, or securities violation in every transaction in everyday life. Right? And I think that the banks obviously are very happy to go and say there should be every single step of the way on any decentralized or centralized exchange globally should meet very strict regulatory and licensing things, because then they have the exemption of being a bank. They already have that stuff in. So what a great way to kill off the competitive thing until all of a sudden the only legal blockchains are the ones that are, you know, licensed by R3 and Corda and our bank chains, and then whoo, we got rid of this. So there's a little bit of self-serving interest we have to realize on this. So you know, we're gonna see what happens, but I
do think that the SEC has been shown that on the blockchain, it's much easier to track who's doing what than in the cash society. So
absolutely.
I think that much of the education has already been done. So adding additional components is not something at this moment that they're particularly looking at, because they feel confident that the blockchain tracking of moving of money, now I can't say something for Monero, but for other kinds of digital assets is pretty good.
And we as a society, because this all happened kind of post 9/11, which was 17 years ago, you know, and seems to be doubling down rather than adapting to new technologies and times. We as a society have to decide how much freedom versus how much security do we want, because the ultimate security emulates Nazi Germany, and everybody gets frisked when they leave their home in the market in the morning, and they get frisked.
I live in Berlin, by the way.
So,
no longer controlled by the Nazis.
We're coming to the end of the panel. We have one question. That gentleman has been waiting for 10 minutes.
So I want to do the crypto anarchist farmer perspective, in which the whole Howey security test thing is like, if I write some code, and I've written code that has money supplies or whatever, it's like I'm actually creating money when I write the code. Now, whether anybody else wants to use it, that's to me is the important part. And if I don't take any money, if I don't take any portion of this new stable coin that I create to like price commodities in or something, then I'm speaking. It's free speech. And
actually, the CFTC recently said that they don't think that's free speech.
Well, that's a good question. If I don't take
that the coder, irrespective of your money, they're not looking at whether or not you raised money, but that the person who does the coding has an ongoing responsibility and could be both responsible to the government and responsible to the users of that code thereafter.
See, and I think this sounds like a great First Amendment test case right there.
All right. I'd like to thank the panel for being here. Donna, thank you very much for being here. Alexander, Brian, and also EDAN. Thanks a lot. Michael is staying on stage for now, because if you guys can leave, it'd be great, so we get some the last speaker in.
Thanks, guys.
All right, thank you.